What if I told you one metal is on the verge of breaking the global economy? Every solar panel on every rooftop, every electric vehicle rolling off the line, every 5G tower rising into the sky. They all depend on a single resource, silver. And we're running out. Not in 50 years, not in 10, right now. In the next 20 minutes, I'm going to walk you through the four-stage pattern that has repeated in every major commodity crisis in history, from oil in the 1970s to wheat during the Irish famine to palladium in the early 2000s. And I'll show you, with verifiable public data, that silver has officially entered stage 3. The stage where the outcome becomes mathematically unavoidable. But before we get to the pattern, let's start with the numbers. The ones that should terrify every government on Earth. Global silver inventories on. Major exchanges, down 60% in just 4 years. Solar panel demand by 2026, 200 million ounces annually, up from just 85 million in 2020. And here's what makes this moment unlike any shortage you've heard about. This isn't a minor squeeze or a supply hiccup. Industrial demand for silver is doubling in under a decade, while global supply remains flat, rigid, and slow to respond. And remember, silver isn't just an industrial input, it's young money. It has been for thousands of years, which means when demand explodes from both factories and investors, the world is about to relearn what happens when a foundational metal hits stage 4. For more than 5,000 years, silver has held a unique place in human history. It's the only metal that has served two roles at the same time: a critical material for industry and a trusted form of money. That combination is rare, and it becomes incredibly important when demand suddenly surges. Because when a metal needed for modern technology collides with a financial system built on endless debt, the result isn't a normal price increase, it's fear, instability, and panic. Before you assume this is an exaggeration, let me make something clear. This isn't a prediction, it's a pattern, one that shows up again and again throughout history. Every major commodity boom follows a 4-stage cycle, and silver has now entered stage 3. At this point, the outcome isn't guesswork, it's math. Here's the cycle in simple terms. Stage 1 begins when there's plenty of supply. The metal is cheap, easy to get, and no one feels any urgency to find more. People assume that supply will always be enough to cover demand. Stage 2 starts when demand suddenly jumps. A new technology or industry needs far more of the metal, like solar panels and electric vehicles do today. But mining doesn't respond quickly. It takes years, sometimes decades, to develop new production. Nature doesn't speed up just because the market wants it to. Prices begin to rise, but only slowly at first. Stage 3 is when people finally recognize the truth. Supply will never catch up. Inventories shrink, shortages appear, and financial markets that rely on paper promises of metal start losing control because the physical metal simply isn't there. This is the stage we're in right now. Stage 4 is when everything breaks. Prices don't just go up, they explode. Governments rush to secure supplies. Industries begin to hoard. And what started as a market imbalance turns into a full-blown crisis. I'm going to show this pattern 3 different times, in 3 completely different eras, so you can see it clearly for yourself. Once you understand the pattern, it's impossible to forget it. Let's begin with oil in the 1970s. Stage 1 ran from 1945 to 1970 when oil was cheap, about $3 a barrel, and gasoline cost around 30 cents. After World War II, the entire global economy was built on the belief that cheap, endless energy would always be available. But then came stage 2 of the cycle. Demand surged. Europe was rebuilding, suburbs were expanding, and car ownership was rising fast. At the same time, U.S. oil production hit its peak in 1970, turning America into a net importer. Any meaningful new supply was still years away. The North Sea fields, for example, wouldn't begin producing until the late 1970s. Stage 3 arrived in October 1973 during the Yom Kippur War, when OPEC announced an oil embargo. Prices didn't just rise, they skyrocketed, quadrupling in a matter of weeks. The embargo was only part of the story. The real shock came from the realization that the era of cheap energy was officially over. Gas stations had lines stretching down the street, and factories began slowing down. Then came Stage 4. By 1980, oil had climbed from $3 a barrel to $35, a tenfold increase in just a decade. Inflation surged, economies struggled, and central banks lost control. The pattern was undeniable. We see the same cycle in the 1840s during the Irish potato famine, but this example shows a deeper and more painful truth. Stage 1. Ireland had 8 million people, most relying almost entirely on potatoes for food. Potatoes were cheap, plentiful, and treated as if they would always be there. Wheat existed, but wasn't considered necessary. Stage 2 began in 1845, when a potato disease from North America swept through Ireland. 40% of the crop was destroyed in a single season. By 1846, the British government realized that this wasn't a temporary problem, it was the beginning of a multi-year disaster. And this is where the lesson becomes critical for understanding silver today. Stage 3 reveals that even though wheat and other grains existed, prices rose so sharply that the poorest people couldn't afford them. The physical food wasn't gone, but the price became so extreme that it might as well have been. A real-world shortage created a price shock so severe that available food became unreachable for the people who needed it most. Stage 4 was the tragedy that followed. 1 million people died, and 2 million emigrated. Ireland's population dropped by a quarter. Wheat stayed expensive for years. The system didn't fail because food vanished. It failed because prices rose faster than help could arrive. Keep that idea in mind. The same pattern appeared again in the early 2000s with palladium. A more modern and financially driven example. Stage 1. Throughout the 1990s, palladium was cheap, overlooked, and mostly ignored by investors. Stage 2 began in the early 2000s when global emissions rules tightened, increasing demand and pushing the metal into the next phase of the cycle. Palladium moved into its next phase when it became the preferred metal for catalytic converters. As global emissions rules tightened, automakers needed a material that could handle higher standards, and palladium fit the requirement perfectly. Demand rose quickly, but the problem was simple and unavoidable. Palladium isn't mined on its own, it's a byproduct of mining other metals. That means even if the world suddenly needs more palladium, miners can't simply increase production. The supply is locked in place, no matter how much demand grows. Economists call this inelastic supply, but in plain terms, it means the market has no quick way to respond. By 2019, the market had endured 8 straight years where demand outpaced supply. Inventories were drained. Russia, which produced around 40% of the world's palladium, had no reason to increase output or push prices down. Financial markets tried to keep everything stable by selling paper contracts, but eventually the physical market broke free from the paper market. The actual metal became harder to find than the numbers on trading screens suggested. That's when Stage 3 fully took hold. Then came Stage 4, and the change was explosive. Palladium jumped from about $500 an ounce in 2016 to nearly $3,000 by 2020, a 6-fold increase in just 4 years. Prices only cooled when car manufacturers made an expensive and inefficient decision to redesign their systems so they could switch back to platinum. It wasn't ideal, but it was the only way to escape sky-high palladium costs. This moment is important because it shows what happens when physical supply simply cannot meet real-world industrial demand. Prices don't rise gently, they spike violently and unpredictably. Now, this same pattern maps perfectly onto what is happening with silver today. Stage 1 was defined by decades of complacency. For more than 40 years, silver stayed remarkably cheap. Even after adjusting for inflation, silver today costs less than it did in 1980. Think about that. Nearly half a century of economic expansion, massive technological growth, and global monetary inflation, and silver barely moved. Why? Because for a long time, supply exceeded demand. Large deposits were developed, and several governments sold off strategic reserves. Silver became an afterthought, treated as a dull, uninteresting metal. The system grew comfortable, even careless. Stage 2 began when demand quietly began to surge, colliding with a supply that could not grow fast enough. In 2010, solar panels barely made a dent in global energy production. Today, solar energy is the fastest growing power source in the world. Almost every modern solar panel uses silver paste, and nothing has matched its performance or efficiency. Each megawatt of solar power requires roughly 20 grams of silver, and the International Energy Agency estimates the world will install more than 400 gigawatts of solar power annually by the mid-2020s. That alone requires around 200 million ounces of silver every year, just for solar. But solar is only one piece of the puzzle. Electric vehicles use twice as much silver as gas-powered cars. 5G towers require silver for high-speed communication components. Medical tools, consumer electronics, batteries, sensors, almost every advanced technology we rely on needs silver somewhere in its design. Industrial demand has now climbed to roughly 1 billion ounces per year. Meanwhile, global silver production peaked in 2015 at about 880 million ounces and has been flat or declining since then. The reason is simple. Most silver, around 70%, comes as a byproduct of mining other metals like copper, zinc, and lead. Mining companies don't dig specifically for silver. They extract base metals, and silver shows up alongside them if the geology happens to allow it. If prices rise, miners can't ramp up silver production unless the base metals become profitable enough to justify new investment. But base metal prices are unstable, and mining investment levels are at multi-decade lows. As a result, new silver supply is barely growing. In some regions, it's shrinking. This creates a clash between skyrocketing demand and supply that is practically frozen. The market can't simply produce more silver on command. That is what makes the situation so serious. Supply is rigid, demand is accelerating, and that brings us to stage 3, a phase defined by the recognition that the shortfall between what the world needs and what the world can produce is no longer temporary, but structural. And this is exactly where we are right now. Silver's shortage is not a future problem, it's unfolding right now. In 2020, major exchanges held around 400 million ounces of registered silver. Today, that number has fallen to less than 60 million. To understand how alarming that is, consider this. 60 million ounces is only enough to supply the world for less than 3 weeks. The Silver Institute has already confirmed 3 straight years where demand exceeded supply. At the same time, premiums for physical silver are rising. Delivery times are getting longer, and the gap between paper contracts and actual metal is widening. For every real ounce of silver that exists, roughly 100 ounces are traded on paper, and that imbalance is starting to break down. We are watching inventories get drained in real time, and major industrial buyers are quietly building stockpiles because they know what is coming. This is not a momentary shortage. It is the start of a long-term supply crisis with no easy fix. Stage 4, panic, has not arrived yet, but it is getting close. The next phase will likely start when a large industrial company, perhaps a major solar panel manufacturer or a defense contractor, publicly announces that it cannot secure enough silver to continue normal operations. That single event would trigger a chain reaction. Competitors would rush to buy whatever silver they can find. Governments would move to secure supplies for national energy programs and defense needs. Investor demand would surge as people try to protect themselves. The paper market would come under extreme pressure, and the exchange could respond by changing the rules, limiting deliveries, or forcing some traders to settle in cash. This has happened before in other commodities, and the same conditions are forming again. Once physical silver breaks away from paper pricing, and once industrial demand collides with monetary demand, prices won't rise in a steady, manageable way. They will leap upward in sudden jumps, $50, $75, $100 per ounce. These are not guesses. They are the natural results of a market with rising demand, shrinking supply, and almost no inventory buffer left. Some people believe technology will solve this problem, but that belief falls apart under closer inspection. There is no practical substitute for silver and solar panels that can maintain the same level of efficiency. Copper corrodes and loses performance. Aluminum cannot conduct electricity well enough. No amount of innovation can change the basic reality of the periodic table. Recycling isn't a solution either. Less than 20% of silver from electronics is recovered because the amount in each device is too small to make extraction economical. Solar panels, one of the largest sources of demand, last about 25 years, which means the silver inside them won't return to the market for decades. Mining more silver also won't provide a quick fix. Bringing a new mine into production typically takes 7 to 10 years, and the world does not have 10 years to solve this problem. The supply shortage is happening now. On top of that, silver grades in the earth are declining, which means miners must process more rock just to produce the same amount of silver. Some argue that demand might fall, but the only way that happens is if the global shift toward renewable energy halts completely. That isn't realistic. The energy transition is locked in by law across Europe, China, and the United States. Silver is at the center of that transition, and the world is using more of it every year with no replacement in sight. Governments around the world have already committed trillions of dollars to the energy transition. Entire industries have redesigned their operations, rebuilt factories, and shifted their long-term strategies to rely on technologies that depend heavily on silver. These aren't temporary programs or optional initiatives. They are hard-coded into national policy. And policy doesn't slow down or reverse just because the price of silver rises. Governments don't rewrite climate mandates, EV adoption laws, or renewable energy targets based on the cost of one metal. The machine keeps moving forward, no matter how tight the market becomes. Some people believe that the United States, with its enormous economic power, global influence, and reserve currency status, can somehow avoid the consequences of a supply-demand crisis. But history proves otherwise. In the 1970s, America, then the most dominant nation on Earth, was thrown into chaos by a single resource shock. When OPEC cut oil exports, the U.S. faced gas lines stretching for blocks, inflation that reached double digits, and nearly a decade of economic stagnation. If the world's strongest country could be humbled by the shortage of one commodity, it shows a simple truth. No nation, no matter how powerful, can escape the basic laws of physics, geology, and resource availability. Silver obeys those same laws. It isn't a policy tool governments can adjust on command. It is a finite resource being consumed far faster than it is being replaced. And once the imbalance between consumption and production reaches a breaking point, the correction is never gradual. It is sudden, sharp, and unavoidable. When demand outpaces supply long enough, the market is forced to reset violently. The cycle behind this isn't theory. It's a historical pattern that has repeated across every major commodity crisis. Complacency during times of abundance, supply that cannot adjust when demand spikes, recognition of a deepening shortage, and finally, panic when the market realizes the situation cannot be reversed quickly. We have seen this in oil during the 1970s, in wheat during the Irish famine, in palladium during the 2000s. And now, unmistakably, we are seeing the same pattern emerge in silver. Silver now sits at the crossroads of three massive forces that are all accelerating at the same time. First, the global energy transformation is consuming silver at a rate never seen before. Solar panels, EVs, electrical infrastructure, and emerging technologies all depend on it. Second, ongoing monetary instability is driving more investors toward hard assets as trust in fiat currencies weakens. And third, silver supply is trapped by geological limits, mining delays, declining ore grades, and the fact that most silver is produced only as a byproduct. These three forces do not move backward. They do not reverse. And as they combine, the market is approaching a moment where price will not simply increase, but break away from historical norms entirely. This isn't a prediction, it's simple arithmetic. When consumption exceeds production and inventories continue shrinking, price must rise. There is no alternative outcome. Markets can bend for a while under financial pressure, but they cannot escape physical reality. Once the demand from industry collides with the demand from investors, the shift will be fast and unmistakable. Anyone can verify the data. You can look at the reported inventories from major exchanges and see how sharply they've fallen. You can check the International Energy Agency's projections for global solar capacity and see how much silver future installations require. You can study the Silver Institute's annual reports and confirm that the world is running repeated deficits. You can look at global mining statistics and see that production is flat while demand surges. Nothing is hidden. Nothing is theoretical. It's all public and easy to confirm. Understanding this isn't about hype. It's about seeing the mechanics behind the market. When the gap between physical supply and real demand becomes too large, the financial system that has held silver down for decades begins to crack. For years, paper contracts and derivatives masked the true scarcity of the metal. But that system has limits, and those limits are now being tested in real time. Once the separation between paper pricing and physical availability breaks open, silver doesn't move in small steps. It jumps into an entirely new range. The pattern is there, the evidence is public. The machine is already in motion. The only real question is whether you choose to see it before the rest of the world does.